Welcome to the Multifamily Deal Lab Podcast, where we dissect a deal before your eyes and ears so you can discover the strategies and tactics that got each deal to the finish line. Strategies and tactics that you can put in your own toolbox to get you to the closing table. From sourcing the deal, raising, due diligence to the property takeover, Multifamily Deal Lab shows how you too can get the deal done. And now here's your host, David Lindahl.
Everybody, welcome to Multifamily Deal Lab. I'm your host, Dave Lindahl. And we got a couple of special guests with us today. But before we go to our deal dissector today, I want to share some information that one of my partners sent over. And it was an article that CoStar had written. And it basically says that over the next 2 years, the market could expect to see 13,000 loans totaling $148 billion held in commercial-backed securities, CMBSs, default. That represents 14% of the loan count and 11% of the dollar amount that currently make up CMBS universe. Historical CoStar data shows that when a massive amount of distressed sales flood the market in a short period of time, properties are liquidated at prices not much lower than their outstanding loan balance, but also much lower than the market value of similar properties in the same location. I should have said prices not only much lower than their outstanding loan balance. So the ratio of distressed property sales to total transactions reached a peak of 32% in 2010, about a year and a half after the last big downslide, the Great Recession, and slid down to 2% before the coronavirus outbreak. So it goes on to say, once defaulted loans are liquidated, the properties backing them could sell at an average of 1/3 their pre-coronavirus value, based on CoStar risk analytics, which is similar to the severity in the Great Depression. So, I've had a couple of different guests on, Mike Flaherty being one. I forget the name of the other individual, but who talked about how they started investing after the last downturn and how well they did going into now, how they pretty much set themselves up. So right there, the opportunity is being defined by CoStar as a risk analysis of all the loans that they see, the commercial loans that they saw out there outstanding. Another part of this was graphs, and it shows that the values they expect to see for these particular loans, not in the market overall, but for these particular loans, apartment values to decrease by 65%. A lot of people ask about office and retail. Office 68%, retail 76%. So there is a huge amount of opportunity. That's why we talk about getting prepared now, sharpen your axes now, and you'll be prepared to do deals like these two were. Tell everybody who you are and where you're from.
I am Rebecca Stupnagel. We're from Phoenix, Arizona.
And I'm Brian Ayers, her business partner, and I'm here in Phoenix, Arizona as well.
All right. So you guys are from Phoenix. You guys formed a partnership. Tell everybody, how did you form your partnership? First of all, how did you meet each other? How did you decide that, this is the other person I want to do deals with?
Well, I can take this one because my story is a little bit, my picture's a little bit brighter. So we actually met in a business group. I was a home inspector. She was an appraiser. And so we started doing work together in a totally separate business.
Is that a B&I group?
Yes, a B&I group, yeah. And so we started doing that. And then her as an appraiser and me as a contractor, home inspector, we started flipping houses together. And after, I would say probably about 2025, we decided we wanted to get into multifamily. And that's really where we really turned up our partnership to the multifamily industry. And really wanted to learn as much as we could in this industry.
How long ago was that?
2 years ago. So it was 2 years ago in February, I think we joined your group that we originally joined, I think it was February, March 2 years ago.
And what have you been doing? I know the deal that I want to dissect, but what else have you done? Have you done other deals?
So we've done 7 deals in the past 2 years.
Nice. From what ranges? What size deals?
Our smallest deal was like 1.75 million, 49 units, and our biggest one was 12.25.
Wow, what was the acquisition fee on that 12.25?
It was $550,000. I always like to go for dollar amounts, and so yeah.
That must have been a nice check to get.
Yes,
yeah.
Always.
I wanted to just mention B&I. B&I is Business Networking International. I remember when I first started in business many years ago, and my story is I went from landscaper to real estate investor to construction, landscaping, construction, and then investing. And they said, if you want to, join business groups in order to get ahead in this world, and they'll help, you help each other. And they said one of the best ones to join is a BNI, Business Networking International. And the great thing about it is they only allow one particular person from one particular industry to join. So you'd have it by yourself, and then they help each other get business. So I checked in my area of Brockton. First, there was none in Brockton. And then so I went to the next nearest city, which was Quincy, and they already had, I also owned a real estate brokerage company. So they already had real estate brokerage there. They already had a contractor there. So then the next far out was Needham, which was another like 10, 15 miles away. Nothing over there was available. I checked all the different areas, Fall River, everything was booked. So somebody said, well, why don't you start your own? Brockton needs one, you might as well start one. So I thought, well, I never even thought of that. Here I am starting out in business, I got a bunch of things going on, and to actually start and run a group. So I thought, well, probably just like starting another business, and then they'd help me do it. So I started the Brockton chapter of BNI many, many moons ago, way back in, I think, 1994, 1995. Ran it for a couple of years, as you can be the president for 1 year, and then it's got to turn over. But they actually kept me on for the second year. And then I either attended or had somebody from one of my businesses, because I've had multiple businesses through the years, attend that right for like almost 20 plus years. So it's a great organization, BNI.
And you learn really well who you work well with, and it's such a good group, but it is, like you said, starting a BNI chapter or being involved is another business in itself. So you've got to make sure you include that on your resume there on businesses that you created, because running a BNI or starting a BNI group is a lot of work.
Yeah, so they do give you good support, which is good.
Oh yeah, it's great support, great group, great organization. I'm very happy to be proud to be a part of that, to have been a part of that. Unfortunately, with the multifamily is really our focus. It hasn't been a need for us to be in the BNI group, but I can tell you, because I partnered with Rebecca, my close a business, and so that's how they track their success in BNI. For anybody who's listening, is not a part of BNI. My Thank You Close a Business is doing really well because of BNI and the partnerships that I made within that group. So I'm very excited and to have had that part of my story.
So most BNI groups has a realtor, but they don't think about having an investor. So you could propose that, you'd like to take the spot as an investor, and there's usually an open spot. So that's something for people. All right. So let's talk. So you did 7 deals. Do you happen to have any idea of how much equity you've created in the last 2 years? Doing those 7 years deals?
I could tell you not total equity. I would probably say because we really do focus on the value adds. My background being a contractor, I'm looking for that value add. So I would say we're probably total equity gain, and obviously with the COVID thing, it kind of puts a wrench in it a little bit, especially with your report that you just told me that everything's going to be worth a third of what I.
No, just those loans that are in default.
Yeah. I would say, in excess of $10 million in the last 2 years in total equity across our investors. Because we really do kind of focus on, when we do a project, how much of that equity is our investors getting from day one. For example, we did a property here in the Phoenix Metro, and just at closing, I think we had almost $2 million because we had it in escrow for almost a year in a very hot Phoenix market. And we had almost $2 million in equity at closing that we got to share, obviously, with our investors just at the day of closing. I mean, we actually had offers the day after closing. We got a random call, somebody who wanted to buy it the day after we bought it.
How much more?
What's that?
Or how much more than what you paid for it?
It wasn't enough to pay the taxes, but it was more. It was more than, obviously if they called us a week prior, it might have changed the story a little bit, but because we had just closed, and then obviously the tax, and we haven't had a chance to, it was a rehab. It was definitely a value add property. And so, we didn't have a chance to do anything with it after one day. But I can say, we've owned that property for 11 months now, and we really turned that property around, and we are, planning on exit that property relatively quickly, and the returns being better managed and cleaned up and repaired, and it was in a great market. It just was something that was an absentee owner that just had money coming in elsewhere and wasn't really too concerned with the prosperity of that property.
All right, so I want to turn to the deal that you guys did with a master lease option. Master lease option is one of my favorite subjects. It's probably it's a good tool to have in your toolbox. You're not going to use it a lot, but when you get the opportunity to use it, it works out really, really well. So I'm going to have you guys, one of you two, explain what a master lease option is. I got to go across to my office and just grab something. I'll be right back, but I'll be able to hear everything. So why don't you explain to everybody what a master lease option act is and how you got into the situation?
So a master lease is basically when you can get a property under contract. We were close to closing on our deal, but with the master lease, we ended up taking ownership of the property and taking over the property from that point. So we put a down payment to execute the master lease, and then we're able to take over operations, and we're able to go ahead and do everything on the property, that we need to. And so all the profits then become ours. In our situation, we ended up needing it because of what's happening right now in the current market with COVID, and because of, everything that kind of changed, with everything, we were able to execute the master lease and be able to take over on the property and, give a return to our investors. So basically our lease payments are exactly the amount that the seller is paying in mortgage payments. So they're not making any sort of profit on the property, but we're able to go ahead and serve everyone in the property going forward.
So are you making the mortgage payment direct, or are you paying it to the owner?
We're making it directly.
Excellent. Good. Because that's a mistake that people have made in the past by paying the owner the mortgage, and then they don't pay the mortgage, and the property starts getting into arrears. So for everybody, a master lease option is typically you use this strategy when the property is in some sort of distress and you're not quite sure sometimes if you can actually turn it around. So it gives you a certain period of time, which is your option period, to exercise on the purchase of the property, and you can really take a good look at the property. You can start executing your plan on the property, always knowing that you've got to be careful that if you're going to start putting a lot of money into the property, you just have to protect that deed. That deed has to be somewhere in an escrow account to be delivered upon your request. Everything has to be in writing, because you don't want to improve the property to the point where the owner all of a sudden looks at it and says, oh my gosh, this is a great property now. I don't think I want to sell it. So you just recently closed on this then, is that right?
Yes, April 1st.
So were you buying it conventionally at first, and then you realized that there's some problems here that you may not be able to analyze, so therefore you need to go a different direction?
No, for us, it actually kind of fell into our lap. So we were originally supposed to do a conventional close. We were scheduled to close on March 31st, and then on March 27th, the lending dried up. We've been going through the lending process, got pre-approved. Everything was going great. We were told on Monday that we were going to close early. We were planning on closing Thursday or Friday of March, the end of March, and then we didn't have to close until the 31st. So I think it was like the 27th or 28th. That they told us that they're walking away. The lender is closing shop because of the COVID uncertainties and whatnot. So for us, that gave us 4 days before and we'd already done an extension. And so we needed to come up with something that fit the seller's needs and secured, obviously, our earnest deposits. And we knew with the property going in, again, this is one of those other properties that's a value add. It was a 2011 build that had some severe plumbing issues. So from a standpoint of the issues that the sellers didn't have the cash to do anything to improve the property, so it just kept being a snowball of a problem for them. And so we knew that once we had a property unsecured, that we could then finance it. So we just did the master lease as an example to secure our position, to hold it so that way we can get financing over the next 18 months, and then to manage the property, get the rents up, get the occupancy up. They had it down to 73%. We have it up to 90. We have 99% of the tenants are paying.
Before we go there, I want to go back to the master lease decision. So when the bank pulled away, did you have any money that was hard, non-refundable? Yes. How much?
$90,000.
$90,000. Yeah. Was it your money or was it your investor's money?
Combination.
So when the bank said they're walking away, so how long did the panic attack last for?
It wasn't that long, because we were able to call and talk to Jeannie and, run through our options, which is always, amazing. You guys are always there for us. And, the master lease was one of our, options kind of moving forward because we had already gone through all of our extensions on the property.
So you presented it to the owner, and what was the owner thinking? Now, did you say the property was 73% when you took it over?
It was 73% when we originally went under contract. We've since got it up to 90% within the, last couple months. The sellers did part of it, along the way, and then we increased it as well. But originally, the sellers aren't professional property managers. One of the sellers is a former football player from Texas A&M, and they're just not equipped to, handle everything. They've been kind of, putting a Band-Aid on a larger problem for a long time.
If you're not trained properly, like we said, this is the perfect example of what we've been talking about with the opportunity that's going to exist in this marketplace. It's the marginal managers, their problems are going to rise to the top. Their property is going to rise up there. They're the ones that are going to lose during this period because they just were never trained properly to manage their asset. And you don't have to be a good property manager. You have to be a good asset manager and know what numbers to look for. And then when the numbers aren't right, you need to be looking at that Monday morning report. I mean, that has all the key information on there. And then if one of those numbers aren't right on that report, you need to know how to dive into it and figure out what the core root of the problem is and fix it and move forward from there. So you presented the master lease to owners. How did that go? And how did you present it? What was your strategy?
Presented it as an option for them because they were terrified, going into, COVID and the uncertainties. They also had a residential team that was doing their collections. So they had a Berkshire Hathaway team, not a professional property management team in there as well. And they weren't doing a lot of the notices that they needed to as far as, what was going on in the market, where you can get help with all the Texas TAA, notices. They weren't, doing any of those. So when we presented it to them, we kind of offered them an out of, we can give you, because there was not a lot of equity in the property to begin with from their standpoint. And so they were only going to get not an awful lot at closing on the closing table for taking over this property. When we originally got it under contract, they built it for $7 million in 2011, and we had it under contract for 5.2. So there was not a lot of that they were getting at the closing table. So we were able to present it more as an option for them to get out of managing the property and, allowing us to take over in the kind of a time of need for all their tenants.
So that goes back to my, when I was talking about master lease option, works best with distressed sellers. So these sellers were definitely distressed.
Obviously, as this pandemic is growing, in distressful times is when the master lease is going to be an absolutely awesome tool to secure an option on a property. Like you said, from a owner who isn't doing it professionally or doing it properly, and the lending market might have dried up. And so, it's going to devalue the property, but this gives you another option to secure an asset that has a potential for definite growth. And like you had mentioned earlier in the call about during the downtimes is when you're going to make the majority of your money. And so this just gives you an option to put less down, secure the property, turn it around, and then refinance out of it or finance out of it to secure your position and do actually even better than at any other time.
You're absolutely right there. And you made another good point, and that is that it's a good tool to have in your toolbox for the up and coming market because there's going to be a lot of distressed sellers. I remember about 4 or 5 years ago when the market was really hot, about 2016, I think, about 5 years after the last downturn. And somebody came out with a program for master lease option as the way to, build this huge portfolio, taking no money out of your pocket. And I thought to myself, well, master lease options are great, but they're not great at this particular time in the market because it was weird. It was only 2 days before that I had read something in one of the financial journals that 1% of all apartment deals the previous year had been done through a master lease option. So if somebody at that time was going to try to get rich by doing master lease options and taking no money out of their pocket, it just wasn't going to happen because it wasn't the right time in the market for that particular tool. But going forward, it is going to be the right time in the market, and we're going to see a lot of different opportunities there. So that's good. So let's dissect the rest of this deal. The total number of units was how much? How many?
60 units or 132 student housing beds.
So what university is it near?
This is Texas A&M. This is College Station.
Oh, all right. I thought for some reason I thought you were in Phoenix. Okay, so
we are in Phoenix, but we do most of our buying in Texas. For whatever reason, Texas has been very nice to us. We found a really good management company, and we find a lot of secondary markets that we really do well in Texas. So we really do like Texas.
Yeah, and they've got a great government for business there, so it's a good place to do business. So 60 units. It was how much did you pay for it?
$5.2 million.
5.2, and it was at the time of takeover 73% occupancy, but now you've gotten it to where?
90%. So
what was the problem? Why was it at 73? I mean, when you did your diagnosis, because whenever you do a repositioning, anything below 85% occupancy is below equilibrium, and that automatically makes it a repositioning deal. So anytime you're looking at a deal like that, the first thing you have to do is say to yourself, can I diagnose this problem? Can I clearly see the problem here? And then number two is, can I fix this problem? So what was your diagnosis of the problem?
So what we do is we kind of look at the property, and then we look at all the neighboring properties. Everybody else was at 95, 97% occupancy, and we were at 73. So we knew that there had to be either a management issue right off the bat, or there's conditions issue. The property shows very well, obviously with the plumbing issues that causes people to leave when their stuff gets all wet and then it's not repaired. So that is an ongoing issue. So we look at it from either management or aesthetics. If you're basing it on a comparison market, I mean, there's a property right next door that's 97% occupied. There was no on-site manager. There's a beautiful office on site that's empty. And they had a sign, one of those for sale sign, 12 by 16 sign. They had a phone number to call to rent. And then if you were to call that number, you had to drive 2.5 miles away. The management company would give you keys. Then you would come look at the property by yourself, and then you'd return the keys. And then you decide if you wanted the property, if you wanted to rent it or not.
Wow.
So they did not have any services in play. The management, the owners, they basically had gotten themselves into a position where they didn't have an option because they had 4 partners who were running out of money. They were trying to put Band-Aids on it, and it just kept snowballing out of control. And this is, of course, after dissecting and doing a really big overview on it. And these are a lot of my own assumptions on people's philosophy on how they look into things. But this is part of the game for me, I guess. So really what happens is they were not properly managing the place at all. And every time that I went there for an inspection, we would be there and 2 or 3 people would show up to rent the place, and there was no one there to greet them. And so the reason why it was, and once we pointed this out, again, I think we did one of our inspections in January. And once we pointed this out to them, the owners realized that the management company that they had in place wasn't doing what they were supposed to. And so then they turned it up a little bit and then started renting it out a little bit before we even took over. So.
Did they live close by?
Well, they were all scattered. We had some in Hawaii. We love our Hawaii owners for whatever reason. Hawaii owners do well because they're absentee. I guess it's called island time. So we bought a couple of our properties from Hawaii owners, and they're really big. What's that?
I love Hawaii.
Yeah, oh yeah, but it seems like 2 of our owners had neglected properties that really they left so much money on the table because they just neglected the management. We obviously view this as a business, not just a hobby, not just, it's not going to just fall in our lap. This is a business for us. And so we really kind of look at, like you said, we kind of dive down on what's the issue, whether it be aesthetics, like property, or management.
So let's go to the plumbing problem. What was that plumbing problem? How did you diagnose this? What was it? And then how did you fix it?
Yes. So locally in the area, they did a PEX plumbing, which is a very common plumbing. But the company that they used is no longer in business. It's a PEX, which is the chemical compound that they put together to make a PEX plumbing, which is just a universal name. But the company that put this PEX plumbing together, I guess forgot or got the compound wrong. And so there's a lot of leaks. And so back in 2015 or 16, they lost a big lawsuit. They went out of business. But obviously that money disappeared in blink of an eye with attorneys and other people who were in line first. And so the PEX just needs, all the plumbing throughout all 4 buildings needs to be replaced. And so obviously that's, a big significance. So, we might have $2 million in equity, but we know that we have about a $500,000 repair bill ahead of us to replace all of this PEX plumbing.
So have you started that? What's your plan? How are you going to phase that in? And where are these things happening? Or are they coming up from the ground?
It's totally random. It's up in the ceiling, up in the walls. It's just the PEX. Basically, it can't take the pressure and it just pops, and then it'll just start leaking all over the place. It's in the floor where we'll have washouts underneath. It's a pier built, so there's not an issue of severe foundation issues, but definitely water just starts leaking and gushing, and then they go out there, they fix it, put a Band-Aid on it, and then, go about their day. So what we did from a contracting standpoint, we knew this going in. They were very upfront about that, about the issue. And so we had several plumbers, contractors, foundation people. We ran this thing through for, 9-year-old building. We ran this thing through, we had multiple contractors and out there to give us assessment, give us bids, how much it's going to cost to replace the plumbing drywall. Can they access it without damaging the cabinets? If they have to damage a cabinet or remove a cabinet, is it salvageable? We went through the whole thing to get a true cost, took all 3 bids across the board, and then we went with the worst case scenario, and then we added to it to protect us and our investors. Obviously me being a contractor and having a plumbing background, I was a plumber for 8 years. So I have a background in this, so it really suited us well, where most people were probably fearful. I was like, oh, this is, if very worst, I'm moving to Cal State, I'll be working for a while, but obviously that's not the goal of this business, but worst case scenario, we knew we had this under control. So
how are you going to phase it in? Are you doing one building at a time, one unit at a time? What's the plan?
We're doing is going to do the vacant units. So we're going to do all of the home runs. So from the meter to every one of them comes up into the laundry room. So we're going to go section by section.
Explain that term home run, because that probably just...
Yeah, so from the meter to the shutoff in the laundry room, there's a main shutoff for every apartment, each individual unit in the laundry room, and they're all stacked. So they're all vertical of each other. All the laundry rooms are stacked on top of each other. So what we're going to do is go from the meter to each laundry room first, and then on every vacant unit, we're going to go through. So right now we have 6 vacant. We're going to go through, do all of the plumbing in the vacants, and then we're going to move between either change of leases or offering to move people to these vacant units, and then those 6 will be vacant, and then we'll go those 6. We're going to try to do them in a vertical, top to bottom. But again, it just kind of depends on where the vacants are, but we're going to put it in a system. And we've talked with several of the plumbers that we had on that out there, and they all had different ideas on how they wanted to do it. And we collectively, with our management team, Class A management, we put together something with them. And then that was the other issue too. The other thing I want to bring up is our management team. She's actually done this once before on another one of her properties that they purchased a couple years back. So she was familiar with this whole thing when we brought her in. So that was, that's a fantastic, just bringing in the right people is the best thing in this business, is making sure that, and that's the one thing I do want to say. It's kind of off topic, but within the RM Mentor program, is you get to meet so many different people who have, done different things. And so you just have to ask and not let the, I know it all, I've done it all, and been, find somebody who's done what you need to do and ask them, and just take the best of it or the worst of it and ask a couple other people as well and make a decision on there on what you can do. But that to me is the comfort of, when we hit the master lease issue, we got 3 days to close or we're going to lose $90,000 between me and my investors. I mean, that's, like you said, that's the panic attack. And so to be able to pick up the phone call and call people and come up with ideas fast to get the situation under control was amazing. And so it's a credit to, again, I know this is off topic, not on the plumbing issue, but it is a credit to the team of people and the people that surround the RM Mentor program that I'm glad to be a part of. So sorry, a little off tangent, but
that's right. That's what we pride ourselves on, is support.
Yeah.
How are you keeping your tenants in there? They know this is a property that has plumbing problems. What type of communication did you give them, in order for them to feel comfortable with the fact that, okay, this place there's leaks coming out of all the walls, but yet I still want to stay? How did you handle that?
Yeah.
mostly it's just staying in communication with them. We had, prior to us taking over, there were a lot of tenants that were uneasy about, going into, the current environment. But they had really good rates, on their apartments based on everyone else that was in the, industry. Because right now they're below market rents. And so because they were below market, they were willing to put up with, the minor pinhole leaks, the minor inconveniences. But they were putting a Band-Aid on a bigger problem. When we took over the office, there was a calendar in the office. They hadn't been in the office since 2017. And
wow.
Just having a presence on site, because our on-site leasing person lives in the property right now. And just having that person on site that you can go to, with an issue and get, immediate maintenance available to them has been, very helpful. That, bond between the, tenants and owner. So we've been very fortunate, to be able to take over and give them the support that they need.
All right, great. Well, I want to thank you guys for being on and sharing your wisdom and allowing me to dissect your deal. And congratulations. Good luck out there. And I want to thank everybody else for being on this Deal Lab call. And we will talk again. Take care.
You've been listening to the Multifamily Deal Lab Podcast, where the deals get done. If you'd like to learn more, visit davesfreebook.com. And don't forget to leave a 5-star rating and review and hit that subscribe button so you don't miss an episode. Thanks for listening.